Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell, and stocks mixed while optimism over U.S. trade deals rises. President Donald Trump has announced via Truth Social that the U.S. has reached a deal with Vietnam 1 week ahead of a July 9th deadline for tariffs. Trump stated the terms are that Vietnam will pay the United States a 20% tariff on any and all goods sent into our territory and a 40% tariff on any transshipping. Let's welcome in our team coverage here with Barbara Duran, BDA Capital Partners CEO and CIO, as well as Yahoo Finance's Ben Werschel and Brooke DePalma, who are all joining us throughout the show to break down the headlines. Ben, start us off here on the latest with that trade deal.
Yeah, so this rate that Trump announced today is sort of a halfway point between the 10% rate that is currently on Vietnam and the 46% rate that Trump held up at the chart on Liberation Day in early April. So we're sort of halfway in between there, and Trump says what he got in return for that is total access for the U.S. for U.S. goods that'll come in at a zero tariff there. The readout we have from Vietnam is much more limited. They describe it much more as a framework to eventually reach a deal, which is a divide we've seen between Trump and other countries for years now. But there are some clear specifics here. One is about autos. The Vietnamese did confirm that the country will be open to U.S. autos. Trump talked about this as well, talked about American SUVs possibly being in Vietnam in the future because of this. Commerce Secretary Howard Lutnick also described this as a win for farmers, which suggests crops are going to be a part of this. The two big unknowns just for folks to focus on here. One is exactly what he means by this transshipping, this 40% rate. This is a part clearly aimed at China, but transshipping can take a lot of different forms. Is it when you sort of unload it from the boat and put it back on a different boat, or is it a product made in Vietnam that's with Chinese parts? Is it a product made in Vietnam with some Chinese parts? All of this line that gets drawn is very important, and it sort of suggests what the deal is going to be here. So we still don't know that. The other big question I think for markets here is what sort of template this provides going forward. This comes a week ahead of what's being called Liberation Day 2.0, where we're expecting a lot more trade deals. So how much is this going to be a template? Capital Economics had a note today suggest this might not be a total template here. They describe Vietnam as having kind of the weakest hand, one of the weakest hands among all of these negotiations that are going on. And what Trump has suggested is that there's going to be a flurry of deals. There's going to be letters where new tariffs are announced, and then we're going to go forward to this thing next week. Henrietta Trez, I think, just a final note, I think offered a good rule of thumb for folks trying to navigate this. What she noted is that the data we have so far is that Trump has come in at about half of what he offered on Liberation Day 1.0 in April. Basically, in the Vietnam example, 46% became 20%, and that's backed up in what we know so far. So that could be the template of what we know going forward about what Trump's going to announce in the coming days. Ben,
I was talking to an analyst who covers the retail sector today, and he asked a question, which I'll now ask you, which is that 20%, Ben, is that on top of existing tariffs? Like, is it stacked, or that 20% is replacing them, or we don't know yet?
We don't know yet. That is the short answer there. This stacking issue you talk about is a big one, but Trump, I mean, my reading of Trump's announcement, we're going off basically a Trump social post and a very short article in Vietnamese state media. It implied it as the blanket rate, so it could suggest that it replaces all those, but that's a detail we don't know yet. The bottom line for these retailers, though, is 20% is really high, even if that's just it. I've seen some reaction today too, that if you're making footwear in Vietnam right now, this is a big thing to have to pay a 20%, which would be an increase from what you're paying already.
All right, and Brooke, what does this deal mean for stocks, and specifically those retailers Ben was just talking about?
Yeah, as Ben had noted, Vietnam is a very particular sourcing region when it comes to both the footwear and athletic wear supply chain. Think about companies like Nike, On, and Deckers. All of those got a bump when Trump had initially tweeted that a deal was reached with Vietnam. Nike jumping as much as 4%, even more as we make our way towards the end of today's trading session. On Holding, which is On Running, they're a major athletic wear based out of Switzerland. They have a heavy exposure to Vietnam Vietnam. Their stock jumped as much as 6%, as well as Deckers pulling back a bit here. Also taking a look at Lululemon, Crocs, and VF Corp. All those are footwear manufacturers that do have exposure to sourcing in Vietnam. Now, if you take a look at the intraday chart for Lululemon, it really tells the story here of what investors saw today or how exactly they reacted. Around 10:25, Trump took to Truth Social to say, hey, everyone, we reached a deal with Vietnam. Details to come. At 10:44, well, we got those details. We learned that it would be a 20% tariff on all imports and a 40% tariff on trans-shipping. And, well, a lot of these companies, they have exposure to China, they have exposure to Vietnam. You see that drop at 10:44 when investors said, oh no, here are the details that we got. And if you take a closer look at this, a lot of these companies, including Crocs, including Deckers, Lululemon, Nike, Skechers, VF Corp, and on, well, they source a lot of their goods out of Vietnam, trying to avoid what we saw during the first Trump administration in China. So a lot of these companies have outsourced. Well, now with this trans-shipping, it's unclear about what exactly this means for that China exposure. But what we've heard over the recent months is really companies doubling down on that exposure to China, albeit no matter what these tariffs end up to be, what we have right now, companies have already warned that they're going to take a hit come Q2. They're going to take a hit in the second half of the year. We heard from Nike. They said that tariff costs are approaching $1 billion as they make way into the year. They also said that right now their exposure to China in particular is around 16%, and they're looking to get that down to a high single digit. They also said that they plan to increase prices in the U.S. and Lululemon, which also saw once again that big reaction today. They also had the worst day since 2020 after their quarterly report, where they warned that tariffs could hit Q2 profits. And so certainly as we make way into this year, these retailers are really trying to understand how much exposure they have to China, now how much the exposure they have to Vietnam. And what we saw back in April when we initially heard that 46% was this shock among all retailers as they tried to digest what exactly this means for earnings this year.
All right, Barbara, I want to get your thoughts here on the deal as well. Listen, we know President Trump, Barbara, he's going to tout this as a win, this deal with Vietnam. But as an investor, Barbara, how do you think about it?
Well, the good news is that the original 46% is off the table, and that bodes well for all the other deals coming, that we're not going to go back to those draconian tariff announcements of April 2nd, which tanked the market for a few weeks there. You know, the bad news, though, is that right now the market has been assuming a 10% across the board, although the effective tariff rate right now is 15%. You know, so the 20% is reasonable, but it is higher by twice, you know, what the market's assuming. And the trans-shipping is quite interesting because these companies are being penalized. They had been switching from China the last 4 to 5 years to diversify their supply chain, and Vietnam was a big beneficiary. And I am sure, and this is what we need to parse out over the coming days and weeks, is how much is being shipped in from China in terms of raw materials or, you know, supplies that are then turned into that, and how is that going to be tariffed? So I think it's pretty complicated, and that part is not good because it is going to raise costs. You know, as just mentioned by Brooke, for all these companies who have tried to diversify, now you can't just say, what is their China exposure? What is their exposure in China and Vietnam?
All big questions still. And Ben, listen, while we still have you, trade deal with Vietnam was front and center, but also, of course, front and center for investors, President Trump's big, beautiful bill. Ben, where do we stand as it moves its way to the House?
Yeah, another long day of negotiations on this. We're now in the House of Representatives stage of this, and all eyes are on fiscal conservatives. This is a group that are really irked by the fact that they sent a bill over that was estimated to cost $2.4 trillion, and it came back estimated to cost about $1 trillion more at 3.3. They had a 2-hour meeting this afternoon at the White House with President Trump. One member at least came out and made a video, Tim Burchett of Tennessee, that sounded some positive notes, but it did not suggest he's a yes yet. His line was, hopefully we get this thing worked out. That comes alongside a flurry of negative commentary from other members of this group who are really unhappy about this top line number. And then there's another market sensitive piece of this to flag here, which is green energy. A big criticism here is some of these green energy provisions that we've been talking about for days that have gone back and forth. They want more intense provisions to exile green energy credits. So if they're going to change this bill, that could be an area they're going to focus on for sure. These group is back back on the Capitol now. They appear to be meeting with Speaker Johnson. We don't have any indication of when they're going to be a vote. The House is still debating the rule to start debate. So I think it's going to be a late night at the earliest, probably tomorrow.
So Ben, are we still confident we're going to make this July 4th deadline, or no? Does it look like, hey, the odds are increases, we're going to start kind of ping-ponging here, and this could go back to the Senate?
Yeah, so there is, the Punchbowl News does a really good tracker of this, and they have the list at 28 lawmakers, GOP lawmakers, who are currently either no or won't commit to vote yes on this. Speaker Johnson needs that number to be 3, so he has quite a ways to go on that. That doesn't mean, and the only way this passes is if they all flip and pass this Senate bill as is. That doesn't mean it won't happen. A lot of these lawmakers have changed their minds in the past, especially under pressure from Donald Trump. So it's going to be an arm twisting phase, and then they're going to try to get to this July deadline. The bottom line I would add for investors is the widespread expectation here in Washington is that even if they don't make this July 4th deadline, which would be a loss for Trump just in the kind of this week, there is a widespread expectation that they get this done in July. So maybe they go back and forth and have to ping pong on a few close provisions, but it has passed both chambers of Congress so far. They're just working out the differences.
And Barbara, I want to get your thoughts here on the bill as well. The big, beautiful bill, Barbara, in your opinion, is it priced in here?
Well, there's a couple things as investors you want to look at, some of the specifics, particularly as concerns green energy, or even there's a proposed change for the HSAs that would benefit fitness stocks. But it's really, for me, the macro approach in terms of what you're looking at. How stimulative is this tax package going to be? I don't think it's going to be like the original tax package, when dramatic drop in corporate rates. This time, we're really seeing an extension of the main tax rates that are in place, and you're going to see on the margin whether you're not taxing overtime or you're not taxing certain Social Security benefits, or not taxing various things. I think that's on the margin. So I'm not sure this is the fiscal stimulus that's being talked about that will really get the growth up, because that's been a big argument about how much it's going to add to the deficit. Because the underlying assumptions are slower growth than the administration would like to use.
All right, Ben, Brooke, thank you so much for helping us kick off the show. Appreciate it. Well, for more on President Donald Trump's big, beautiful bill and what it means for investors, let's welcome in here Michael Reynolds, Glen Mead VP of Investment Strategy. Michael, great to see you. Want to pick up there, Michael, what we were just talking about there, which was President Trump's big, beautiful bill. Michael, I'm curious, let's say, Michael, that does get punched through here. You think the stock market would react and respond how, Michael?
Yeah, so we're looking at some pretty big stimulus out of this bill. We've still got some fireworks in Congress here, maybe a little early for 4th of July, but fireworks nonetheless on some of the details, exactly how we're going to get this through before the 4th of July recess. But overall, we do think something's going to pass, and the details actually don't really matter all that much. But what we're looking at is some decent fiscal stimulus out of this. Yeah, it may not match what we saw in the TCJA just back in 2017, but we're still looking for 2026, possibly as much as 0.8% tailwind to economic growth from the fiscal stimulus alone in this bill, which can help offset some of the impact of tariffs on the other side. We're looking at how markets are digesting this, and there are some pockets where they're pricing this in perhaps a little bit probabilistically, but once Congress is able to get over these hurdles on some of the details and get this moving to somewhere that's probably more workable for both sides, is where you're going to start to see markets really start to price this in more fully.
How do you think the bond market will react, Michael? Lots of talk, and you know this, about this bill and what it means for our debts and deficits long term.
There's quite a bit of chatter that, neither side of the political spectrum is really all that worried right now about impacts of debts and deficits, at least when they have power, at least. We don't think that the Treasury markets are going to go too crazy on this. We saw a little bit of it just a few months ago with the downgrading from Moody's. That was short-lived. Not a lot of new information here. I mean, the details of the bill and really the overarching structure is really well known. And to basically flip the script on how Treasury markets are going to digest this based on them just passing what's already sort of known is sort of difficult to see from here. We'd expect that Treasury markets are going to digest this, but longer term, debts and deficits are something that Congress is going to have to get under control. Whether that moment is now or even this year remains up for debate.
And Michael, so the big, beautiful bill, one headline today, right? But we're also tracking this trade deal with Vietnam that the president announced. We do have this July 9th deadline out there, Michael, but it kind of feels like the markets have decided, you know what, Trump has backed off the kind of maximalist peak tariff threat, and we can kind of live with whatever's going to be imposed here. But what do you make of it?
Well, everyone loves a good 4th of July sale, and that 46% tariff that was going to be imposed on Liberation Day on Vietnam is now looking more like 20%. And so this is really informative for, I think, a couple reasons. Vietnam in particular is probably one of the countries with the least amount of negotiation leverage here. We have a large trade deficit with them. It's actually their exports to us are a large part of their economy, so they really had to come to the table with some concessions. But what it does tell us is that the administration is not going to insist on some of those eye-popping Liberation Day tariffs with quite a few of our trade partners here. It may be indicative of what we could see of some sort of peer nations in the area like Cambodia, Laos, or Malaysia, where we have a similar setup, large trade deficits that end up being a large part of their economy. You could see some asymmetric trade deals. The details matter. We got to kind of read between the lines on the Truth Social post here before we really figure out exactly how this is going to shape up. But it does take off the table on the margin some of, again, those eye-popping numbers we saw on Liberation Day that gave the market its biggest worries at the time.
Michael, one other thing I'm just curious to get your take on is dollar weakness. It's another important theme for investors. Dollar was down about 10% in the first half of the year. Do you see that weakness continuing, Michael? Is it bottoming here? And what does it mean for the market?
Dollar's coming off really just a decade of unrelenting strength. Even if we weren't seeing some of the trade policy stuff coming through this year as it has been, at some point, a little bit of a relief from that rally was relatively warranted. And the trade aspect here is really kind of helping that here. We do think we can continue to see dollar weakness through the end of the year. We're not calling for major changes to the reserve currency status of the dollar. We think those concerns are overblown. But could you see marginal weakness that gets the dollar on a purchasing power basis relatively more in line with its historical record? We certainly can see that. And so when we're talking to our investors about how to take advantage of this, you got to make sure you have non-dollar denominated assets in your portfolio. And in a lot of cases, international equities really fit that bill because they're a productive asset. And if you don't hedge the currency, you can actually benefit from a weakening dollar.
Michael, great to have you on the show today. Thanks so much for joining us. Appreciate it.
Have a nice holiday.
We are just getting started here on Market Domination. Coming right up, Tesla shares riding higher today after Q2 vehicle production top forecast. Going to hear from an analyst on the other side about what's next for the EV makers. Stick around, much more Market Domination. That's still to come. Tesla shares on the rise. It's after reporting second quarter delivery numbers on Wednesday. Those missing the street's expectations. For more, we're going to bring in here Tom Narayan. He's global autos analyst at RBC Capital Markets. Tom, always great to see you, sir, on the show. So Q2 deliveries, 384,000, Tom. Maybe not as bad, Tom, as some on the street feared, but I'm curious, how did that compare to your estimate, Tom?
Yeah, exactly. I think you nailed it. I think people like us, people like myself, I think may have had a higher number. I think it was like around 405. I saw 390 in there. But the investor group, the buy side is really what matters, right? And they were calling for, I think, something around 384, which is what happened. I was actually calling for a 366, so it actually beat my number. You have an April number, you have May across the three regions. It's just June was really hard to predict. That's usually the month that's hard to do. And it looks like in the US, it came in line. And then it looks like China, it came in very strong as kind of I was thinking could be. And, it beat me, I think, in Europe, which is surprising, right? Because that's where a lot of the news was on potential headwinds there. So it's looking all in all like, pretty decent number. It's probably why the stock is up.
And so when your clients ask you, Tom, they say, Tom, what does this core EV business look like ahead? What do you tell them? Because we got the revamped Model Y, we got the new affordable models. What do you see?
Yeah, I mean, look, the Model Y, from what I've read in the press happening in Europe, actually did pretty well. The new refresh in certain countries, I think like Norway and other countries. So it looks like that actually is helping things. It didn't boost demand that much in the U.S. It looks like a decent number in the U.S. So it looks like the Model Y refresh is having some positive impacts. But this new affordable car to hit in Q3, I do think that will be very important. That should boost some volumes. And then, as we know, in September, it looks like we'll be losing the EV tax credit. That could create some kind of pre-buy effect, right? So Q3 may actually wind up being a little bit stronger because I think folks were thinking that EV credit would be lost in December timeframe. It's looking like it's kind of September. So we could see a higher Q3. But all in all, for the full year, I think everybody's expecting it to be slightly down. I'm down like 7%. I think consensus is down like 8%. That's kind of like the kinds of topics that people have been asking about.
So the big beautiful bill, the Senate version would kill that EV tax credit by September, Tom. Beyond just Q3, I'm just curious, as you try to model out long term what the end of that EV tax credit, what does it mean for Tesla?
Yeah, I mean, I think actually that's more of a near-term dynamic. People structurally aren't buying EVs because of a tax credit, right? They're buying EVs because of other reasons. But sure, it'll have an impact, right? So that's probably why volumes are down, this year, Q4 impacts. But remember, you have that offset of this new affordable car that's coming in. They haven't had a new model in years. Like a proper new model. Now, I don't know how dramatically different it will be, but the price point does matter. Maybe that does offset some of the impact of losing the credit. So, I don't expect this huge, robust growth, next year, 2026, mid-teens, something like that. But really longer term is really where I think you could see EV sales, not just for Tesla, but across the board increase because battery prices coming down should have a big effect. Now, that's not happening for near term anytime soon, but longer term, I think it's reasonable to be constructive. We're in this little bit of an EV slowdown in the US. But remember, Tesla sells a lot of cars in China where EVs are booming, and they did really well in the month of June. And then Europe is EV central as well. So I think probably they'll be all right. It's just a little choppiness near term.
You mentioned China, Tom, and there was such an interesting comment from Ford's Jim Farley. I don't know if you saw this, and I want to get your take on it. Yeah. And Farley was talking about the Chinese EV industry, and he was talking, Tom, about how he's made multiple trips over there. And here's how he put it, Tom. He said, "It's the most humbling thing I have ever seen." This is Farley. He says, "They have far superior in-vehicle technology." You agree with that?
Yeah, definitely. We just recently initiated coverage on Porsche, actually, just last week, and China was the focus. There's a car, the Xiaomi SU7, which competes head-on against Porsche's main, Porsche Taycan, and it's priced like a quarter of the price with the same battery range. How do you compete with that, right? So I would agree right now there's a huge advantage in China that a lot of these, brands have, BYD, et cetera. They're vertically integrated. They have the best tech in the vehicle. They have a big advantage on battery prices. And so, but look, remember, the government's subsidizing a lot of this. They have a lot of other advantages being vertically integrated. And battery prices, that spread between what the Chinese companies pay and what the rest of the world pays, that's going to narrow because it's only so low you can get on battery prices. Also, the global players in China are going to learn how to sell to that Chinese consumer, use the local ecosystem on tech, improve their products, vertically integrate as much as they can. And look, at the end of the day, if you are a wealthy Chinese consumer, there is something special about a luxury German brand. There still is. It still has value. So yeah, look, it's tough sledding right now, but we don't see, like the German OEMs, for example, just losing China completely. We probably see them continuing to lose share a little bit near term, but at some point, they'll get better at it, and you'll get some sort of equilibrium.
Tom, always great to see you and to have you on the show. Thank you.
You got it.
Meanwhile, Barbara, I want to get your thoughts on Tesla as well. You don't own this one, Barbara. How come?
I've never owned it, and I don't think I will unless it gets a lot cheaper. Number one for me is the valuation. It's 150 times, and it still is essentially an auto company. Almost 80% of their sales are from autos. You know, and as your last guest just spelled out, it's only now they are refreshing their lineup. It's been some years. They've been way behind in having a new model and a price point. And so they've been losing share everywhere, and particularly in China. He mentioned that China's sales were better, but for 7 straight months they've been, declining, whereas BYO has been on the uptake. So I think they've got a real problem in the car area, and people say, well, it's robotics, it's AI, it's battery and storage, but the battery and storage business, granted, is growing some 65+%, but it's only 10% of sales. And the robo-taxis, they're way behind Waymo, this owned by Alphabet.
So I was going to ask about robo-taxis. They launch in Texas.
Yep.
Folks were excited, Barbara. You weren't.
10 to 12 robo-taxis launched. And there's a test right now going on in Austin and Atlanta, Waymo and Uber, where in Austin alone they have 100 robo-taxis with another couple hundred to come. And they've had 10 million rides and 250,000 a week. That's going to be a long way for Tesla
Is that,
to catch up.
by the way, as an investor, is that how you'd rather play the theme?
Although it's tough to play Waymo because it's tucked inside, Alphabet.
Yep.
And if they ever brought it out, my gosh, if you apply the same valuation that Tesla has to that, the Alphabet stock would be a lot higher.
It's interesting because when we talk about Tesla, it's sort of unique in the sense that Musk is Tesla and Tesla is Musk. And there's plenty of fans of the stock, I'm sure, who are listening right now, and they just believe in the man and the vision, and they say, yeah, he's right. The future, it's robo-taxis and it's robots, and Tesla's going to be a big player.
Yeah, a lot still do, although, as we know, the brand was also tarnished by his recent foray into politics, and a lot of people, who did not agree with his views. And that has hurt sales. And you've seen that in Europe, you've seen it in Scandinavia, you've seen it here. And I think that's been a problem. And that's where you're going to have to see if he can turn that around, because there's definitely been some brand damage for Tesla. So we will see how that works out.
Yeah, he doesn't seem as closely aligned to Trump these days, though.
It seems he's actively trying to distance himself.
All right, thank you, Barbara. Nike stock, meanwhile, that jumped after Trump says the U.S. has reached a trade deal with Vietnam. I'm going to speak to an analyst on the other side to discuss what's next for retailers. Stick around. Much more market domination. That's still to come. Well, gold continued to break records in the first half of 2025, breaking above the 3,000 level for the first time ever. But that's not the only stunner, with Bitcoin outperforming the S&P 500's gains so far this year. For more on what's ahead for the remainder of 2025, let's get to IDX Advisors Chief Investment Officer. That would be Ben McMillan. Ben, let's talk gold here. The great Ed Yardeni, Ben, writing to his clients this morning, here's what he says. He says, gold's advance to 4,000 per ounce is more of when than an if. Growing number of financial behemoths, he says, Goldman, Morgan Stanley, Bank of America, now see this milestone as all but inevitable. Is it inevitable, Ben?
I read that exact same report, and I agree. It is inevitable. It's a matter of if, not when. And the key thing to keep in mind here is this is a change. This is a structural shift in the gold market, specifically in gold demand. So the gold market is actually sending us a signal. And frankly, it's sending investors the same signal that the long bond market is on the weakness side. And it's that there's simply just too much debt in the system, specifically as it relates to the U.S. If you looked at the European Central Bank Forum yesterday in Spain, Powell himself said that the path of U.S. debt is unsustainable. And if you looked, I was watching that live, the gold market got a bid directly after those comments. So I wouldn't be surprised if we close out the year at $4,000 an ounce for gold. Now, that's not to say it's going to be a straight line up. We're seeing it consolidate here, but it's definitely a structural change in the demand curve for gold.
When I read Yardeni's note, Ben, it seemed to be one reason he said was driving this gold rush. He seemed to be saying it's central bankers all around the world who are just scooping up gold to diversify their reserves away from the dollar. Is that how you see it?
100%. And so if you go back to COVID, so since COVID, central banks, largely China, India, some of the smaller ones around the margin have basically doubled their annual purchases of gold, for the last several years since COVID, since 2020. And China's even gone so far as to kind of obfuscate their buying in terms of setting up shell companies and things like that. They don't want people to know how much gold they have. Meanwhile, you look at some of the recent treasury auctions, especially in the long end, and foreign demand has been really weak. So again, this is consistent with, central banks starting to sell treasuries, buy gold, and it makes a lot of sense. Ken Rogoff has a new book out, and I haven't read it yet, but some of the excerpts, he talks about, the idea of, all right, if not the dollar, what's the next best kind of global reserve currency? And he makes the point that, well, in fact, we used to have one, which was gold back when dollar was pegged to gold. So to circle back, absolutely, central banks are by far the biggest driver, marginal buyer of gold, which has been kind of driving this bid up, and that doesn't show any signs of really slowing down.
Would you, Ben, rather own the metal, the miners, or both?
The short answer is both. Now, the caveat here, of course, is, the miners are volatile. There's an operating company on top of that, but there's operating leverage. There's embedded leverage there. So when the price of gold does really well, oftentimes the miners, disproportionately benefit. The other thing with the miners too is there's kind of an embedded M&A play there too. If you kind of look at the the large big household names, and we like ETFs for this. This is where diversification really is really worth its weight in gold, pun intended. But in some of the juniors, these are companies that are likely to some of them are likely to get acquired. So you've got an embedded M&A bid there. You've got a price of gold that's really supporting their operating the operating companies. And, like I said, there's volatility there, but we think owning both is the play.
Barbara, I want to bring you in here as well. Your thoughts on the yellow metal, Barbara?
Yeah, well, I agree with both Ben and Ed that there was a structural change in demand. And I think there's a couple other things going on. I mean, first, you've looked at the percentage of dollar held in foreign reserves for the last 25 years has gone down from 70% to 57%. There's a diversification away from the dollar where possible. We're still the world's reserve currency, but it's about managing risk. And I think gold really got a big boost when the foreign reserves of Russia were frozen, 300 billion when they invaded Ukraine. That was back in 22, and that's when you saw the central banks really pick up their buying. And initially it was not just twice, but it was 5 times their buying. And you look at countries like India has maybe 10% of their reserves in gold versus us or Germany at 75% in gold. You've got, I think India's 10%, China's 5%, so they have a long way to go. So I think the demand is going to continue for quite some time, and I think 4,000 is totally possible in the not distant future.
So, Ben, a lot of good, smart reasons, as Barbara's pointing out there, for optimism around gold. Before you pile in there, what would be some of the downside risks, Ben, I should think about?
Well, I mean, obviously, for whatever reason, central banks could retract buying. I don't think it's likely. Barbara made a good point I want to underscore is when the U.S. kind of unilaterally moved to confiscate, dollar-denominated assets of, certain Russian oligarchs and players and things like that, value judgments aside, the world looked at that and said, oh my gosh, this is possible. We need to think about diversifying away from the dollar. So again, this is a shift in the demand curve that is not likely to slow down. Now, that said, markets are very good about overreacting. We've seen this with, AI. We've seen this with .coms. That's not to say gold can't get, bid up to the point where, it doesn't make sense anymore. But even then, we've seen a lot of gold bugs start to move into silver for that exact reason. So that's one of the reasons we like diversifying, within the precious metals complex, within the miners. But, the only other thing is, like I said, short of a wholesale retreat in central bank buying, if we got sticky inflation, for example, and rates didn't come down like the market expected, typically that's a headwind for gold. But those are risks that look compelling at this point.
And Barbara, when you're buying gold for your clients, is it just with the GLD?
Yeah, I buy the GLD because it's the most liquid. It's easy to buy. I would certainly not be buying physical gold. I think you've got storage costs, and also I think it's very tough to resell. So in the GLD, I think it's a good thing, which, by the way, in itself is another source of demand. It's competing for the same gold bullion that central banks are.
Ben, last question here before I let you go. We talked gold. Got to get your thoughts on digital gold, Ben. Let's talk Bitcoin. I thought of you, Ben, because here's the economist and strategist David Rosenberg, and he was saying, kind of laying out the case for Bitcoin's second half. Here's what he sees, Ben. He says Bitcoin enters the second half of 25 with a variety of tailwinds. He points these out. He says post-halving supply constraints, deepening institutional adoption, and explosive demand through spot ETFs. That, he says, continues to drive the bullish case. Do you agree with Mr. Rosenberg?
I agree with all three of those, and I would highlight the institutional adoption. And in particular, so not only do we have a more favorable regulatory backdrop, And that's been known. We saw Bitcoin get a bid at the beginning of the year, largely because of that. But now what really is interesting is kind of stable coin adoption. And that's interesting because that's the on-ramp, or that's the rails, so to speak, that brings Main Street at large into the Bitcoin ecosystem. So a lot of folks that don't necessarily want to take, the market risk of Bitcoin, but might like stable coins for payments and things like that. That was another interesting tidbit that came out of the ECB forum yesterday, was that all of the central bankers, acknowledge that stable coins are here. They're here to stay. They're going to be part of our infrastructure going forward. And I think that's a very underappreciated, massive tailwind for institutional adoption.
Ben, always good to see and to have you on the show. Thank you, sir.
Yep, thanks.
Nike stock jumping after Trump says the U.S. has reached a trade deal with Vietnam. We're going to speak to an analyst on the other side to discuss what's next for retailers. Stick around, much more market domination. That's still to come. President Trump saying the U.S. has reached a trade deal with Vietnam. In this agreement, Vietnam's goods import to the U.S. would face a 20% tariff. Shares of retailers such as On Holding and Nike climbing on the back of this trade deal. It's all coming 1 week ahead of that July 9th deadline for tariff deals before levies snap back to higher levels for the U.S. partners. For more on the retail landscape, let's bring in now Williams Trading Equity Analyst Sam Poser. Sam, it is good to see you, Sam. And of course, you are just the man to talk to about this, Sam. You saw Trump say, listen, we got this deal now with Vietnam. How are you thinking through this, Sam, and what it potentially means for your coverage universe?
Well, I mean, I think the good news is that, once we find out what's going on, there should be a good sense of certainty here. The unknowns are, is this going to be incremental in the footwear world? Is it going to be incremental tariffs above the tariffs that often reach 20% even before they went to the additional 46 and then lowered it to 10? So the question is this going to be a net 20% tariff, which I think would be very good news, or is this lopping on another 10% on top of the 10% on top, which would then raise the tariffs to around 40%, which would be bad news from pricing. And we don't know how the consumer is going to respond to pricing in general.
So if I'm hearing you right, Sam, you're saying bottom line, as we sit here right now, for investors, still too many balls in the air, Sam, too many questions still?
Well, I think that I think the one thing we do know is that companies will be able to plan once they have a number they can count on, which is good. And from that sense, there's more certainty. From what the number is and how that will impact certain companies, that's the question. And we're hopeful that we get some details on that shortly.
Generally, Sam, if I'm an investor in that retail landscape, do I want to try to find that retailer who has the really compelling product, who would have the ability to raise those prices if necessary?
Well, the brand or the retailer, of course, you want, people are going in asking for certain brands and asking for certain items. And theoretically, those goods, people won't stop asking for them just because they raise price a bit. But there's always the question of how high is too high. So that's a risk to everybody. I think the big risk is if you're, if as a consumer, you sort of say, well, I would love to buy, a Nike shoe, but the price is too much, and then all of a sudden you buy something else, or On, or Hoka, or Birkenstock, or whatever. But right now, the best brands are winning, and I think that if the prices go up, I think you'll see separation. But the question is how much do the unit sales go down as the prices go up? And again, that's dependent on how much the prices go up. And brands are just starting to take the price increases from the 10% additional tariff out of Vietnam now. They may have to do it again if that number is going to 20. And that's the uncertainty and how the consumer is going to respond, regardless of how good a brand is performing today.
So we've got questions, Sam. We've got uncertainty. That doesn't mean there still aren't opportunities, right? I know you argue Nike is one such opportunity. You say that one's a buy. How come, Sam?
We have a buy on Nike. really has nothing to do with any of this. I mean, in Nike, back almost a year ago now, when Elliot Hill came in as CEO, we knew that we didn't know, but we had the good instinct that this turnaround was going to start, and it was going to take 15 to 18 months. Initially, we moved it up to about a year. Shortly after, we sort of figured out that there were probably some good product in some sample rooms that never saw the light of day under their old leadership. And we do anticipate some fairly good pickup when we get into holiday this year, as Nike ex-China is expecting the marketplace to be pretty clean, and retailers are liking the product that retailers are seeing is being better received than it has been recently, though retailers say there's still a ways to go. So and then the initial reads, what we've heard from spring 26, have been good. So everything other than China being a bit worse than what we anticipated is happening as we had. And if the tariff situation gets nailed down and they can plan, it'll be good news. And if, as we hear, Nike's coming out with some more compelling product, that becomes better news, and so on and so forth.
Yeah, Barbara, I want to bring you in here as well, because Barbara, we were talking off camera, and you didn't sound as excited about Nike. How come?
No, because the stock has moved off its low in anticipation of new management turning things around, but they did serious damage to the brand over those last 10 years, really trying to cut out the wholesalers and go direct to consumer. They made a lot of mistakes, and by giving up a lot of shelf space, they allowed new entrants to come in, whether it's any of the brands or any of the newcomers that have been mentioned, and they've gained serious share with good product. So, as Sam said, though, the key will be they've got to get great product out there. Their innovation engine was a bit broken there, and that was something they were known for. But it's going to, even with great shoes, great brands coming out, it's going to take a while to get back on it. They just have lost significant share. So I think that the stock has moved up, but it's hard for me to see where it goes from here in the near term.
Sam, what do you make of those comments?
Well, I've heard them repeatedly from lots of people of late. I would say, one, Nike is still the biggest brand out there and the most powerful. So they have more leverage even when their business is tough with their wholesale accounts, which means basically the retailers understand that they see the product improving and they know they need to work with Nike. If Nike says, look, you don't want to work with us, when we really get things in full gear, we're not going to take care of you, and they mean that. If with Adidas or other brands, you say, look, I've had enough, and they threaten to do that, when they have good product, they'll still sell you. Plus, my checks say that the kids still really love the Nike brand. They just haven't had but they'll buy it on sale, not at regular price, and that's because of the lack of innovation. And And also, just to put it in perspective, Nike's SG&A budget is over 3 times the size of Under Armour's total revenue, and their demand creation budget is almost the same size as Under Armour's revenue. So you've got this machine that was completely focused on transactional marketing. Now they're going back to brand marketing with better product that's coming, if it's the Pegasus Premium or the Vomero Plus and the Vomero Premium that's coming out for holiday. We've heard from retailers that the Air Force, and from Nike, that the Air Force One issue is pretty much taken care of, and we're hearing from retailers that the Jordan 1 issue should be taken care of by the time we get into a holiday. And then lastly, and most overlooked, I believe, is what they call their core business, which is this under $100 business that was really done through the family footwear channel, and that's part of what's going on with Amazon. And it's a hugely profitable business. It's not glamorous whatsoever, but it was completely pushed to the side under Donahoe's reign, and they're reinvesting there. And again, a huge opportunity for them. And the feedback from that channel has also been quite good, moving in the right direction across categories. And there's a lot of shoes there. Back in 2013 to 2017, there's a shoe called the Tangent, which was arguably a poor man's Roshi, which was the shoe that sold to Foot Locker and so on. And that was their number one unit and dollar volume shoe for about 4 or 5 years running. And that's in the family, in that more moderate channel. And again, that was an abandoned ship, and they're rewriting that now. And I just hear and see it's not, they're at the bottom. It's hard to see the forest from the trees here, but we're seeing that despite the fact that others are not.
Sam, before I let you go, I want to get one more name in here because so you like Nike. You don't have many sales, Sam, but one you do have is VF Corp. Yeah. I look at that one, Sam. The stock's been shelled already. It's down about 40% this year, but you say still avoid it.
Yeah, I mean, with VF Corp, they're trying to do too much with too many different things. Vans sort of is a version of what Nike was, but their path to getting out of there is starting to focus more on women, more on apparel, more on lots of other things. And comfort is the word of the day. And even with their new school shoe, which is more comfortable than the old school, they're still not that comfortable. And I think that's one of the problems. And two, they're just not focusing. And then the North Face business is pretty good, but again, I think they're going all over the place. Timberland having a moment with their iconic wheat or yellow boot, however you want to say it, but they don't look at the old country casual business they once had, and they keep wanting to lean on that wheat boot and derivatives of that wheat boot. And that historically has blown itself up every time they do it. So I anticipate a decent year for Timberland this year, but I just think they're going to blow it up again. There's lack of focus. Their CEO's been there 2 years and hasn't told anybody anything about what he's really going to do, except for the fact that they said they wanted to grow North Face by 2.5 times, but gave no time frame for that. And again, it looked like they wanted to shoot in a lot of different directions away from their core to get there. So and they have a big debt load, which I think is going to end up biting them.
Sam, always good to see you. Appreciate your time and those picks. Thank you.
Thanks so much, guys. Have a great one.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination Overtime.